Can't help it. I gotta laugh at the inflation fear mongers. It's fun because the arguments are weak, and I'm gonna prove it to you again and again and again and again and again. Deflation will be where we head, and short-term stuff. And I say short-term, certainly could be not for the next 3 years. Inflationary comes. The idea of long-term inflation. Some guy, he posts on my YouTube channel. We're gonna have 15% inflation for the next 5 to 10 years, and he's not putting his money in cash because he'll lose half the purchasing value in 3 years. And I'm like, oh, jeez. So I was like, what stocks? Stocks should be alternative. All right. So let's dive into it. So I'm not straw manning. I mean, maybe I am. I don't think so. The argument's the same old arguments. The government spends too much. We have too much debt. The deficits are too big. Just that simple. That is inflation. That's what they say, literally. And there's too much M2, too much money supply. And is it M2 anymore? Yeah, I think it's M2. Too much monetary supply. All right, so we'll hit all these once and for all. The inflation, what's they say? The ultimate inflation guide. All right, so here's the total public debt as a percentage of GDP. I can't remember when they changed it from GNP, gross national product, to GDP. I don't recall, but we're just going to use GDP, and that's going back to right here, 1966. All right, so fools would say, look at that! Total public debt to GDP, oh my goodness, went from 106% to 135 in a matter of 2 years. 1 year. Oh, now we're back down again. All right, so anyway, they'll say it went from 108, or what is it, 106 in Q4 2019 to Q right there for 2020 to 129. All right, so what do we say? 106 went up by 20. We'll take our trusty calculator. 23 divided by 106, I think it was. The total debt to GDP went up by 21% in a 1 year time. Okay. So then we have to say, okay, well, total debt to GDP is what the cause was of 121% increase in the course of a year. How do you explain this? From 1982, total debt to GDP was at 30%, to 1994 is at 64%. It went up by over 100% in those 12 years. How do you explain that? Now, it didn't go up in 21% in 1 year, I grant you, but it went from right there, 31, we'll just say until, we'll say to Q30, let's see, 31 right there, Q4, 31, and it went to 43 in 4 years. So we take our trusty calculator, divide by 31, it went up by 40% in 4 years. But it still went up from 30 in Q1, actually when Reagan took office, right, yeah, Q1 right there, about 30, so about 30, we'll just say 31. And by the time Bush lost in 92, it was at 61. It went up by 100% in, was that 10 years? That's a 7%, 7.2% increase in debt to GDP. No inflation. Then it started going down. Clinton got in office. Republicans took over, started going down. No inflation. When I say no inflation, I'm talking about typical inflation. We're always going to assume a 2 to 3% target because that's what the Fed is targeting. So we can't say, I'm just talking high, not even high, forget hyperinflation, high inflation. All right, so you see, I'm sorry about sniffles. So it went down, no inflation. It gradually went up. And then from 2008, it went from 62 to 100 in 2013. So 5 years, it went up by, freaking 38 divided by 62. It went up by 61% in 5 years. No inflation. But then even funnier, what we'll do is make this a log. No, Barky McGee. And when we make it a logarithm, you'll see it doesn't look nearly as bad because the logarithm shows you everything in percentages as opposed, look at that. That's just a tiny little blip right there. So look at this. Whoop, no inflation. No inflation until right here. So is this a cause of inflation? If that's the cause of inflation, how come there wasn't any inflation here? How come there wasn't any inflation here? Ironically, from 1966 to 1982 was the highest inflation years we had. And look at the debt to GDP. Went from, was that 40 to freaking, what is that, 30? Went down by 33%. So again, the idea that the debt to GDP level is going to cause inflation, it's just freaking stupid, man. I mean, look at it. Debt to GDP goes from 40 to 30 from 1966 to 1982. There was the highest inflation we've ever had in the United States. Debt to GDP goes up by doubling over the next 12 years. We whipped inflation out once and for all. Debt to GDP went back down, no inflation. I mean, a little bit inflation, but not much. And again, we're saying never close to the highest we had from the 60s and 70s. Debt to GDP kind of leveled off, no inflation. Debt to GDP spiked from 2008, 2013, no inflation. But suddenly, right here, massive inflation, and that's because of the Fed spending. Okay, so let's keep going. Finn, before I do that, I always have to show you. Japan, debt to GDP, 266%. 266%. And Western inflation, less than 1%. And what's Japan's debt to GDP been for a long time? I think you got to go to government debt to GDP right here. And we'll go to max, and you can see the debt to GDP broke 200%, not even 100% in 2009. And the inflation has been basically literally non-existent in Japan. So we can nip that in the bud once and for all, and we just did. All right, so now let's keep going. Let's go to surplus or deficits. You can see we had a deficit after the World War I, after World War II. A surplus, but mass deficits. We had mass deficits here. Mass deficits. Did we have inflation in the 1930s? No. Why did we not have inflation in the 1930s? Because they call that the Great Depression. Not only deflation, a recession, deflation, depression. So we have mass deficits and no inflation to speak of. Mass deficits, no inflation to speak of. Probably the best time for growth in the history of the world after the World War II, right there. All right. So then we're basically puddling along, a little bit of deficits, not anything significant as it turns out. And then Reagan takes over in 1982 right here. And all of a sudden we have mass deficits, 5% of the GDP of the economy, essentially. And people are screaming bloody murder. Reagan's spending too much. He's robbing our grandkids. Did we have mass inflation? No. Again, one of the best growth oriented from 1982 to 1999 is some of the best growth years we've ever had, even though we had mass deficits. So we already talked about debt to GDP. Now we got deficits, which are just an addition to previous debt. We had a Clinton surplus under Republican Congress. Again, we had a little bit of inflation right here, not huge amounts, a little bit, but not much. And then afterwards, so you can see right here, no inflation to speak of. So this is the inflation right here. That right there caused the inflation. It didn't cause it over here. It didn't cause it over here. Didn't cause it over here. But suddenly it caused that. That is the cause. The deficits are the cause of inflation. Okay? Deficits are the cause of inflation. Debt to GDP is the cause of inflation, even though there's no evidence of that whatsoever. It's freaking silly. All right, so let's go down to federal debt versus GDP. We're going to go back all the way to the 1800s again. I just want to show you this. We're not going to log this again, but we have decreasing debt to GDP all the way to 1800, Civil War, no inflation. Mass depressions, deflation all over the place. Civil War, we started spending more money we had after the Civil War from basically 1871 to the dawn of the Federal Reserve Board. No inflation, none whatsoever. Even though the debt to GDP, you can see debt to GDP was going down. Debt to GDP was going down, no inflation. We had depressions, the 1871 to 1826. I got a book on that here. The latter part, the beginning of the 20th century. And of course, the stock market did okay, but we had no inflation to speak of. We had deflation for the most part of from the 1800s to basically the beginning of the Federal Reserve Board. It was deflation. It wasn't inflation, even though the debt to GDP was going down. All right. So then we got from World War II or World War I, the debt to GDP went up. Did we have inflation in the 20s? No, not really. I mean, we had a depression, a mini depression right here, 1920, 21. And then the debt to GDP fell again. And then again, going back to 1930, the debt to GDP through the roof. You shouldn't invest it here because the debt to GDP was so high, even though you would have missed the biggest boom we've ever had historically for the stock market. And then, of course, under Reagan, the debt to GDP was falling, but under Nixon, LBJ, Carter, and then, of course, this was bad years from 1966 to right here to 1982. Look at that, almost identical. 1966 to 1982. High inflation, no growth in the economy, and the debt to GDP was dropping. I mean, look at that. Look at that. And then it started 1982. We started spending money again like drunken sailors, and the debt to GDP started going up. And what happened to your returns? Oh, they went up as well. Interesting, is it not? Something if you can correlate anything, is that the higher the debt, the higher the stock prices go, and the higher the economy grows. I mean, literally, debt to GDP is way up here, the economy takes off. Debt to GDP is way down here, it starts going up, the higher it takes off. I mean, you can make the same correlation as the inflation fear mongers do. Just cherry pick is stupid. I mean, but at the end of the day, look, debt to GDP goes up, and the economy takes off. Debt to GDP goes down, the economy takes off, until right there, 1966 to 1982. Boink. All right, so debt to GDP slows down. The economy is still growing from 1995 to 1999. And then, of course, you haven't had much right here. But yeah, I had a little bit of a blip there. But again, if you did not invest there, you missed some of the greatest returns ever. If you did not invest here, you missed some of the greatest returns ever. So there's no correlation is what I'm saying. You have deflation, inflation. So you can't, there's just no correlation between inflation and debt to GDP. It's just not there. If anything, it's a reverse correlation. It's just not there. All right, then they're going to say money supply. This is a big one right here. Look, Josh, look at the rise. Look at that increase in money supply from 16,000 billion. What's that? I don't even know what that is. 16 trillion? I don't even know. I guess 16 trillion. From 16 trillion to 21 trillion. Oh my goodness, over the course of a year. 16 trillion to 21 trillion. Oh my goodness. So we take our trusty calculator, 5 divided by 16. That's an increase in 31% in the money supply. All right, so we're going to see this right here. That's an increase of 31%. And that looks pretty evil. So everyone's going to say that's what caused inflation, this increase in money supply. Let's change the graph to make it log, shall we? Because, oh boy. All right, let's go to log. Wow. Yeah, look at that. M2 money supply. That's that little bit right there. Yeah, not that big of a deal in the overall scheme of things. So remember, log is 2,000 to 4,000, the same percentages as 4,000 to 8,000, which is the same percentages as 8,000 to 16,000. You can see the monetary supply, other than right here under the Clinton years in the Republican Congress, has been increasing at a pretty steady clip each and every year. So we can click, I guess we can't do it in a log. Let's go back to non-log, and you can just, if you just do this percent, all that matters is percentages. It doesn't matter the actual dollars. It matters as percentages. So if we do from, we had made, let's just go to 5 right there. So we'll just say January of 2001, we had basically $5 trillion of M2, and then so 5 in January. We're going to say in January 2003 we had right there about 5.8. So we went up by 0.8 divided by 5. We went up by 16% in that year from January 2001 to January 2002. January 2003 to January 2004, we went from 5.8 to not much. But again, the percentages are what matter. And if you're saying the percentages are causing an increase in monetary supply, 16% one year is pretty significant. I don't know if we ever had anything like that before. 419 to, let's see, so we're going to let's go to 1960. We had 312, and then December 61, right there, 335. So we take 335 minus 312, divide by 312, and that's a 7% increase in M2. I mean, so if you just log it, so that looks pretty dastardly, 15 to 21. 31% increase, but it's not that significant relative to what we've done historically. Historically, it's just been a pretty level supply, a pretty level change each and every year. But this is what the Fed's trying to do. This is where their targets are inflation on. They're saying we just want to have a consistent increase in monetary supply, M2. You get about 2 to 3% increase in monetary supply, and you're seeing it basically from. Look at this. I don't even know what this is right here. This is okay, I gotta stop doing the log. But you can, that doesn't look that drastic. That doesn't look that drastic, does it? When you do it as a log. All right, then everyone's gonna say, okay, so we already knocked in the monetary supply. Yes, the monetary supply is high, but hold on a second. Why inflation has nothing to do with monetary supply, because the velocity of monetary supply is way down here, man. Look at this. If the velocity of money changing hands essentially has gone from 1.8 in 1960 to 1.2 now, So that's 0.6 divided by 1.8 is literally down 33% from 1960. You don't have to go back that far. We'll just go back to 1997. 2.1 minus, what do we say right now? 1.123, 1.123 divided by 2, what do we say, 2.19? The monetary supply is down, the velocity of money is down 50%. So you can have all the M2 monetary money supply in the world. You can log it or not log it. It doesn't matter if the money isn't changing hands. And this is why you got to read my man Richard Kuh's book on the Holy Grail macroeconomics, because the monetary supply, it doesn't matter if no one's borrowing and spending, if there's a hoarding it. I mean, look at this. And so then you go here from Q3 2019, 1.45 to 1.1. So 1.45 minus 1.1, let's divide by 1.45. And that's a 25% decrease in velocity in less than a year's time, about what, a year's time. And so, yeah, the M2 might have gone up a lot by, what do we say, 30%, but the velocity of money went down by a according amount. Anyway, the point being is none of this is inflationary. I mean, you can pick it. You can say, look, I can show you a graph right here. We can say this is what causes inflation. And everybody will say, you're right, man. You're right there. That causes inflation on, what is this, M2. We can say this is what causes inflation right there, high debt to GDP. Yes, it does. If just fools will follow this stuff. This is what causes inflation, high debts to gross domestic product, just basic deficits, the deficits. Okay, this is what causes inflation right there. I mean, you can say all these things, but then you have to say, well, how about the other stuff? And the other stuff is pretty simple. Let me share this last. Economic ice age that is coming. Could not agree more. This is Dateline December 15th, 2020 by my man Austin Rogers. I could not agree more with this guy. This guy is friggin', I mean, look, could I be wrong? Sure, of course we could. So let's talk about it. The world is caught in a debt trap, 100%. Interest rates are sitting at zero, not so much now. Cheaper credit spurs ballooning debt, even while investors around the world are desperate to find yield, thus keeping interest rates low. But more debt cripples the economy's ability to expand, 100%. Debt, we can talk about crowding out. There are basically three ways to pay for government spending: tax revenue, debt issuance, or money printing, which is inherently inflationary. Well, it's inflationary as long as it gets into the market. If it's sitting in the bank, it's not inflationary. It's just not, man, because people aren't turning it around. If the people aren't turning it around, it's just sitting there catching dust. All else being equal, fiscal deficits soak up domestic private savings, which reduces economic growth by crowding out private investment. I completely, unequivocally agree with that. But it can also be funded through increased trade deficits. Foreigners give us goods, we give them dollars, and they buy our government debt. Given what's going on now, that could be a problem. It's easy to see how this forms a self-reinforcing cycle. More debt leads to lower growth, which leads to more debt, which leads to lower growth. And he's looking at this exact same thing I was just looking at right there. Debt actually crowds out private spending. Private spending crowds out, actually increases the technology, which in some ways could be inflationary 100%, or it could be deflationary because we're like, oh, I got to go back to grinding it out, as opposed to increasing my productivity. And so that's a whole new world there. I'm not going to get into that. But from a pure economic perspective of the last 100 years, debt crowds out private spending. Debt is deflationary inherently, 100%. Debt destroys economic growth. Destroying economic growth is incredibly deflationary. Now, again, that could be, if you look at like Venezuela, the destruction of economic growth is inflationary. So that is something to behold for sure, because it depends on if they're allowing entrepreneurs to continue to exist. If they're going the way of the kulaks or the commies in Ukraine, where they're killing all the kulaks, or going the way of Venezuelans or any commies where they just basically shoot business owners, that's going to be inflationary. But it doesn't have anything to do with the money supply or debt. It has to do with the commies. All right. In my view, the persistent focus from policymakers on increasing consumption, even at the expense of a higher debt load, is short-sighted. It isn't that more government spending can't produce temporary bursts of growth or fill the chasm in consumption caused by the pandemic. It can. But there are two problems. First, that spending necessarily must come from either taxes, private sector income, debt, private savings, or increased trade deficits. And I don't know if you can rely right here. For investors that cannot be relied on permanent, 100%. Money printing is not legally an option for the government at this time. Let's keep going down here. Peak global population and subsequent decline is in sight. Yep. Probably the most predictable of the social sciences demography. And of all the inquiries in demography, population growth is among the most predictable measurements. All right. If you know how many babies are born, how many immigrants are coming and going out, the average lifespan is fairly easy to discern what the population numbers are going to be in the future. Yep. The formula for GDP growth can be thought as broadly as total labor force times total labor productivity. You decline labor productivity. Why? Because private spending is being crowded out by government debt, and you have less labor, you're going to have deflation. No growth, deflation. I'm mixing the two, kind of commingling, but I'm saying there's not going to be growth the way we think. There's going to be low growth, and low growth will lead to less spending. Less spending leads to lower velocity money. Lower velocity money leads to deflation, 100%. Flat labor growth combined with rising labor productivity results in economic growth, as does a growing labor force combined with flat labor productivity, i.e. slavery. But if there's little or no growth in the labor force or in labor productivity, then neither will there be GDP growth. Yep. U.S. labor productivity has averaged about 2.5% from the end of World War II to the mid-70s and has gone down ever since, 100%. Women are having few children, and we talk about that, the fertility, there's not enough babies, man. There's not enough people in the workforce, not enough consumers to continue the spending, which is what causes, 70% of GDP is caused by consumer spending. The primary drivers of falling global fertility rate are education for women and access to contraceptives. Yep, and I would say get away from our founding of a church-based society, but not all is lost. For those of us who have children, I'm telling you, the future belongs to those who show up. Let's just put that way. And if you don't have children, I'm not banging you. I was talking to a guy earlier today, no kids. I'm not saying he's a bad guy or anything. I'm just saying, don't be pessimistic that we're all gonna be, I don't know, whatever, speaking commies and stuff. No. There's a lot of righteous-based people, Christians and Muslims, and lots of righteous Jews who've had many, many children. The Hasidic, the Muslims, the Christians. So the world belongs to the Abrahamic religions in the future for sure. Net migration has been has helped us in terms of as the birth rate has dropped, net migration, but net migration is going down. And it will continue to go. So no one wants to live in America if they can stay in Guatemala. The only reason they come to America is for work and benefits. And if we say we're not giving you benefits, they're not going to get the work, no one's going to come here, man. And you can see global, I almost saw it right here. IHME, remember the IHME? So they're predicting by 2100, we'll actually have about 8.88 billion people, whereas right at the end of 2030, we should have 8.58. So it's not growing very much. We're going to peak right about there in 2064. How population of selected countries might change in the next basically 80 years. China will have half the population, and India will be bigger, and Nigeria will be bigger than China. Even though India is going to drop its population by about 25%, it'll still be bigger than China. And Nigeria will be bigger than China because its population is exploding. U.S. will have a little bit increase, and Japan will be half. Spain, France, Japan, South Korea, China, they're all going to be significantly destroyed because there's not enough people. All right, so population growth is slowing. It will continue to slow around the world until hitting roughly zero in the U.S. and negative territory in many other parts of the world. You can see right here, slow growth population. We also find a secular decline in labor force. Measuring total labor force by a decade, you can see when the baby boomers flooded into the labor force is 1960s, 70s, and 80s. The labor force was strong, and now look at that. Yeah. All right, let's keep looking here. And the labor participation rate. Let's keep going. And what's this one here? All right. Real GDP per capita by expansion. I want to go to the third one. Oh, I guess it only has two. Conclusion. Never in recorded history has a global population shrunk over a sustained period of time. Never has there been any period in history in which the world has carried as much debt as it does today. The confluence of these factors is truly unprecedented. But like the glacial advance of an ice age, it is happening at a slow enough pace to prevent raising as much alarm as merited. Predictions are very difficult to make, but a few seems merited. Governments around the world will move heaven and earth to prevent deflation. I could not agree more because of debt. What's the worst thing you can have in deflation? Debt. Being in debt is horrible in deflation. The proxy metric for the standard of living, real GDP per capita, will continue to see duller and duller growth in the decades ahead, just like it has in Japan over the last few decades. It's simply a function of the slowing labor force growth and slowing labor productivity growth. At some point, economic pressures will force developed nations to switch from a posture of immigration restriction to one of desperation, especially high-skilled ones. And we're already here, man. In fact, we're already at that point, but political pressures are holding back the economic pressures in many countries. Anyway, so there you go. Hopefully this is a good case study on inflation, because it's just, look, you have a couple years, yep. And if it goes full socialist and price and wage controls and things like that, it will be inflationary. No other way around that. Inflationary in the above ground economy. In the below ground economy, let me show you what I'm talking about. And Hernando de Soto, I think it's Peru. So he talks about the informal economy of Peru and the reasons why poverty can be a breeding ground for terrorists. He describes the forces that keep people dependent on underground economies, the bureaucratic barriers for legal property ownership, and the lack of legal structures that recognize and encourage ownership of assets. Where I'm going with that is, even though inflation on the above ground economy might happen, and the other path, the lower economy, the underground economy, you might not see the same thing. It's just, and look at Greece. I mean, we have tons of examples of the underground economy happening all the time. And as such, the inflationary measurements that you see might not be as bad as what you think. I just don't expect inflation to be that big of a deal in the long run. I don't. I think the bigger deal is deflation. And I think I proved it to you. You can't sit there and say inflation is caused by this and I just disprove that. It's simply not true. It's just not. It's like saying, I don't know, what would be a good analogy here? GM laying off people should make the stock fall. Well, it might not. It depends. I mean, I remember my first taste of stock investing. I said GM's laying off people, and all of a sudden the stock price went up. I was like, what? They lay off like a huge amount of their workforce. And the reason was because I said, that doesn't make any sense. That shows they're not producing as much cars. They don't have as much demand in sales. And it turned out, well, labor is the biggest expense, so laying off their people is a quick short-term increase in earnings. I was like, oh boy, that's not good. I don't know if that's the right analogy, but anyway, case study inflation. I hope this helps. Love to hear your thoughts.